Simon, the financial freedom number is a problem. We need to solve for that problem. How do we think about it? How do we solve for that sucker?
Yeah. So if I can share a slide just quickly, it might help put this in perspective. And also, it also comes back to that question of, can I really find 10% or whatever yielding properties today? The reality is, if you want financial freedom, you don't have to. What you need to do is understand the equation for financial freedom and how you might actually then achieve that. So as we said earlier, the financial freedom at its core is this idea that you have income from something not your job that is going to exceed your living expenses. And then by definition, you're financially free. You are free from needing your job. You might choose to work still, but you don't have to work, if that makes sense. So ultimately, people talk about some form of passive income, this income that's coming in without me having to put in constant effort. Now, in order to generate a passive income, you've got to have some sort of cash flowing asset. You need an asset base that spins off cash flow, positive cash flow income, net income beyond its expenses, at a certain rate of return to deliver on that. And it's really that simple. I have a certain amount of money invested at a certain rate of return, creating an income stream, and that income stream needs to exceed my expenses. So you can start off by going, well, okay, how much do I actually need? Let's say, for the sake of argument, that I felt that $100,000 was enough for me to live reasonably comfortably at the standard of living that I'd be happy enough to live at and not have a job. So if I want $100,000, then how much money do I need invested at what rate of return to create $100,000? And it's that simple. So for instance, moving away from this whole idea of 10%, although I would argue that if you're an experienced investor, you build the skill and knowledge and capability and confidence over time to be able to achieve those returns and higher. But let's say, bring it right back to a more identifiable return. Let's say that I was comfortable enough that I could invest in something that would give me a net 5% return. Is that fair enough?
That's a very reasonable number. Yeah.
Great.
Very
so
conservative.
if I want $100,000 in income, and I think I can achieve a net 5% annual return, then all I got to do is take that 100K, divide it by the 5%, and that tells me how much investing capital I need. And in this case, $2 million. $2 million invested at 5% net will give me $100,000 per annum. It's really that simple. But why is that powerful? Well, what that's just told us is that, if I'm looking to create a passive income of 100K and I'm confident I can get at least 5% per annum net on that in order to achieve that, I need to create a capital base, a base of working capital of $2 million. That becomes my financial goal. And then the question is, well, by when do I want that? Obviously tomorrow, but that's not going to happen. So we need to be a bit realistic, and it might take a number of years. In my experience, in the experience of people that we've mentored through the program on this, a realistic time frame for many people might be 5 to 7 years. But you might say, I don't need it now, and 20 years from now is fine. That's okay. So it all scales according to your time frame. You either need to be more intense.
Can I ask a question on that sort of 5 to 7 year figure? Let's say somebody has an relatively average income between, say, 70 or 100K and maybe 70, 100K, maybe they're sort of starting early. Is that realistic with 70 to 100K in 5 to 7 years, you reckon, Simon? Or what do you sort of see?
Yes. And the reason I say that and that I will confidently say that is because we've seen people achieve that over the years in the program. Does that mean that they will get there by saving? No. If they do not apply some sort of investing strategy, they will not achieve that. The concept here is wealth creation. It's not wealth saving. You don't achieve great wealth by saving. Will you have to make sacrifices? Yeah, sure. So you need to look tightly at your budget. How much can I free up? How much can I put aside? Will you have to use smart investing strategies and probably very active investing strategies? Yep. If you're trying to do this by buying a house and holding it for 30 years, well, you've missed your 5 to 7 year time frame to begin with. But it's just ain't going to happen. the other thing you want to recognize on your financial freedom journey, or just your investing journey generally, is that if you want to amp things up, you're not an island. There are plenty of other people out there that probably share similar financial goals to you that you might team up with. And therefore, you can pool your resources and get ahead faster together, if that makes sense. So I'm a big fan of people doing joint ventures and the right way, where everyone's protected, things are properly documented and so on, but with clear financial objectives and achieving bigger things than they might otherwise have been able to do themselves. The question between, just to explain active and passive investing. So we talked a little bit about passive income, this idea that you have income from, say, rent or something like that just comes in. It doesn't require an awful lot of ongoing effort to maintain. Now, we've often said in our program that there's nothing passive about passive income, because there'll always be something. You know, you lose a tenant, you've got a bad property manager, whatever. There'll be problems you have to fix, but they're all fixable.
Yeah.
But passive investing is more about buying an asset, a property in this case, for either capital growth, market-driven capital growth, or an income stream from, say, the rental income. And it's so my main activity is in buying the right property, the right location, with the right timing in order to be able to achieve that. Active investing, on the other hand, involves me getting more involved in the process. I'm more involved in analyzing and identifying areas that are more likely to experience rapid growth in the short term to get me ahead faster. So I'm not taking a 30-year horizon and bringing it right back to shorter period. Or I'm more involved in creating value in the property or creating income from the property. So I am doing something to the property in order to create that. So that could be something like renovation, a subdivision, or a development. And that can be a much faster way to actually get to the point where you could say goodbye to your job, because rather than creating a passive income stream, you might create an active cash producing business, if you like, in your property space that is turning over properties and giving you cash profits, which can replace your job.
What are some of the, I guess, questions to think about or to ask when you're having these conversations with people?
Yeah, look, if you're looking to partner up with someone, one of the most important things, I think, is understanding what it is that they're actually looking for. So, and from a financial goals point of view, what are their goals? And do you have, they don't have to be exactly identical to yours, but do you have an alignment there? Are you heading in the same direction? Because if you've got someone who's very transactional in their approach, they're just looking for a quick win and get out, but you're looking for someone who's, say, you want to be working with them in a business context for a number of years towards the same goal, you've got to disconnect there. You want to understand their experience. What experience do they have that they're going to be bringing to bear here? Have they worked with other developers before in this instance? And how has that gone? What's their appetite for risk and their attitude towards risk? Are they super gung-ho, or do they show at least some respect for the need for due diligence going into deals? And so you you've done exactly what I would suggest anyone should do, considering those sort of partnerships. You invest a lot of time up front actually getting to know the person, their ways of working, their objectives, their financial position, because it's no good teaming up with someone who says, yeah, we'll do a JV together, and I've got $100,000 to chuck in the JV, and then a month later they've gone and blown that $100,000 on the pokies, or they've realized they had to spend it on their kids' education or something like that, and you go, here's the deal, and they go, oh, sorry. Yeah. So you need to have that understanding of where the person's at. I think of it as a lot like a marriage. There's give and take, but there needs to be openness, honesty, transparency between the parties, and a real commitment to working together.
Yeah. And I think everyone's got their individual talents. Where I see relationships break down is when I said I'm not the developer. And he said, I'm not the buyer's agent. I'm not the buyer of this property. And I did not encroach. I asked questions along the journey. He says, I want to learn the development process and go through it and feel it and have some money at risk and have some stake. But I wasn't saying, no, I think we need to be doing this. Oh, no, I think we need to be doing that. He's the developer. You've got to assign roles of who is the expert in their field and what are they an expert at, and how can you leverage that. I see a relationship breakdown where someone comes in and they are not the developer, but they're also saying, well, we need to choose these tiles and this carpet and this paint, and I want to do this. No, this is bullcrap. I want the extra, yard space, so we're going to have to design the house different. No, that's not your expertise. Get an expert and let the expert be their expert.
That's right, and it's so important to work that out at the outset. Responsibilities, the boundaries between what each party's bringing and being responsible for. If you have a mismatch in expectations beneath the surface from the outset, it is toxic to the relationship. Yeah. Almost guarantee that one and done if it's even successful at all. So yeah, it's really important to invest in that relationship building, but equally important to really understand together what everyone's contributing, what we're responsible for.
Yeah.
Let's talk about getting it right from the outset and avoiding some of those really huge mistakes where even experienced developers can come unstuck because they lose sight of this. So there's some real key pitfalls. One of the things you'll always hear people go on about in development is, you've got to have the highest and best use. Now, what does that mean? It means jamming onto a property as many houses, units as you possibly can to maximize the density. And because that's the way that you'll make money, and that's how development works. Absolute crap. It's a recipe for disaster when you go in that blindly, because you don't understand what the market actually wants to buy from you. They might not want your shoebox apartments. They might actually want a house on 400 square meters of land. That might be what's selling, and that might be what makes sense to develop. So where I see developers fall over again and again is they go find a site that can be developed. It's a big enough block. It's got the right zoning. They go to an architect and say, what can I put on this space? And the architect designs a monument to their own ego because they haven't been given any kind of limitations or parameters. The developer goes, great, takes that off to a builder, gets the shock of their life when the builder tells them how much it's actually going to cost to build. But then they take it to a real estate agent, and the real estate agent either says, nobody wants that, or you'll only get this much for those, and suddenly the numbers don't stack up. And what have you done? You've already bought the property, you spent all this money on design, and you've got a dud. Let's avoid all of that by getting it right and understanding that you start at the end. You start by understanding what is selling in the way of new housing in an area. So you do some basic research on something like realestate.com.au just to understand that, and look at what people have actually been buying. And then you go, right, well, rather than reinvent the wheel or start with a blank sheet of paper and just come up with whatever will fit on there, how about I start with that and work out what sites I could actually put that product on, and can I make money out of doing that, or at what price would I need to buy those properties? And that's where people who go into developments on gut feel, without being educated about it, without understanding this concept of a feasibility, which is really just how to do the numbers on a development deal to make sure that before you buy it, you actually expect to make a realistic profit. They'll overlook costs. They will buy something that can be developed, but it doesn't actually turn a profit, in which case it's a futile exercise.
That's like a 1 into 2. I see a lot of people being like, oh, great. Like South Australia, for instance, is probably the easiest example. 600 square meters with an 18-meter frontage. Look, this place is subdividable. Yeah,
and the agent's going to tell you that.
What about the significant tree though grow out the front that's on your property? That means that you can't develop it.
You can't split that bad boy if there's a big old gummy at the back. But it's so true. Like they just don't stack up. 1 into 2s. If you're knocking down a house to put a new house up, I mean, I'm sure there's plenty of examples of where it does, but just generally, if you see subdividable on the real estate listing, you still have to do your due diligence and do all the number crunching, because it'll always say STCA, subject to council approval.
Exactly. Even if there's an overlay on the property that says there's no way in hell that you can subdivide or develop.
I tell you what, I was looking at a property the last year, actually. It was a while ago, and it was a cul-de-sac block with about a 10-meter frontage. And they drew plans. They went to a developer, went to an architect, drew plans, and I saw it, and I was like, "There's no way you can develop on this. Like, I'm not a developer, but I know you can't do it." I called up. They had like the little logo of the person. Called up the developer, and I was like, "Why are you saying that you can split this? It can't, can it? I'd love to know how. Talk to me." And he's like, "Oh, no. The job was draw a picture at the back here with a house, and that's all I did. So do not." And he's like, "I'm like, can it be subdivided?" He's like, "No, of course not." I'm like, "Oh God." He's like, "The guy paid me $500. I'm happy." So you do just be very, very careful of what the real estate agent says. And I imagine, is this a slide to say exactly that? Oh no, here.
That's right. I mean, you might, if you're my age, you might remember the Kevin Costner movie, Field of Dreams, where the voice of God comes down and tells them to build a basketball stadium, because if he builds it, they will come and people will come and attend it. That is the worst possible advice anyone could ever give you when it comes to property development. You've got to understand what people want to buy and deliver to that, irrespective of what the agent's telling you about what the site could be turned into. That's irrelevant. It's what do people actually want to buy in the way of new housing. It's like, what are people actually buying? Simple research on realestate.com.au, what's sold over the last 12 months in the suburb, not the neighboring suburbs, because you could have a totally different market in a specific suburb. And what is it? Are they houses, townhouses, single level units, 2-story places, 2-bedroom, 3-bedroom, 4-bedroom? Where's the sweet spot that people are actually wanting to buy and they're paying a premium for? That's where you start, and then you go looking for your site, not the other way around. Don't know how to analyze comparable sales. You don't know how to figure out your selling price. So you need to look at the end product and find the same thing nearby that sold over the last 6 or 12 months to base that on. Don't just rely on agents' opinions, especially if there's nothing else like it in the market. And don't just rely on what's for sale, because that doesn't tell you what things are actually selling for. Very true. And then those other costs as well, those compliance costs, they can be tens or even hundreds of thousands of dollars. And it's scary to see people just starting out in this space, possibly a lack of education. They don't even know that compliance costs exist. They think, there's a planning permit on this site, it must be build ready. Well, no, it's not. You'll have to go pay council, pay the authorities, get new power, new sewer, pay a development contribution levy to the local council just because you're a developer. And all these other costs. There's a bit of research and spade work required to uncover what they are locally, and consultants as well. You need to go talk to consultants, figure out who you're going to need. You may need designers, surveyors, planners, engineers, building surveyors, and so on. What are they actually going to charge you to be part of this project? And so again, factor all of that in. But you can do some quick and dirty analysis just to help shortlist deals without spending a lot of time on them. And it really comes back down to that idea of, what am I going to sell for? Roughly, what do I think my construction costs are? Subtract one from the other, what's left over to cover the rest and my profit margin, and pay for the property. And there's an envelope if you want to lay it out that way. So estimated selling price, construction cost, which might be sourced from a local builder. How much should I budget per square meter for however many square meters of build? What's left over? What are they asking? Is there anything in it? Or am I going to have to get some sort of insanely high discount off the asking price, in which case we can move along, go to the next one. It's a South Australian property. The block was a fairly rectangular corner block, no easements, no real complex trees or anything like that, a little bit over 650 square meters. The vision, if you like, and the design for this was 3 single level homes on this. Now, they don't exist. So when you're marketing this sort of product, you've got to create a vision for it for your prospective buyers so that they've got something to emotionally engage with. So you get renders done to sell that dream. This is what the plans look like. So you can see the block on the left there has these 3 lots that have been created. You can see the outline of the old house that had to be bowled over. So the house had to be demolished. Subdivision was achieved to create the 3 new lots. So there's certain costs, consultants and compliance costs had to be addressed. And then the plans that were approved for what was to go on there. 3 fairly compact villas, but again, understand what the market actually wants. This is a product in demand in this particular area. So it made sense to do that. So then you've got the numbers in the deal. So this is how a deal like this can come together. Remember, this was completed within the last 12, 18 months.
How long did it take for them to do the deal?
I'm glad you asked that question, and that's a nice segue to my next slide. But in terms of the purchase price, it's sub $600,000 purchase. There were some costs, even though there's no building here. There was planning, subdivision, consultants, a few things that had to be taken care of, the demolition, and so on as well. So total costs just over $700K. Each of the 3
is cheap. Finance,
yeah. So like I say, it's all scalable, isn't it? All right. Yeah. So depending on what you've got to work with in the way of a budget, you can look at more expensive or less expensive areas, as long as you understand, that starting at the end perspective of making sure that the product's in demand and working backwards from that. So here, the land components on each of these sold for $365. So obviously there's a building contract that the buyers have on top of that. So they pay more in total than $365. But in terms of what our member here received in sales values, it was mid 300s for each of them. They'll take out those selling costs. Agents always want to get paid for some reason. It's a bit of marketing, and you've got that GST because what you've created is new land, so it still attracts GST. The estimated profit on this, though, was $287,000. Now, the average income in this country is what, 90 grand, 100 grand, in that sort of range. So that's 2 to 3 years income for most people. But what about tax? Well, your own income's before tax, isn't it? So just treat this the same way. The question was, how long did that take? That took less than 6 months into settlements. So you think about that. If your bank balance, because you get all the original capital you put into the deal back as well. So if your working capital went up by nearly $300,000 in 6 months, would you feel like you're on track to either, in a number of years, achieving that $2 million target for your investing capital for your passive income, or maybe I can take some of this cash and work a few less hours, or do a few of these and get to the point where I go, you know what, I don't need my job anymore. I'll just do this. And that's the sort of the path that we're talking about here with this active investing strategy.
That's an unreal deal. That is awesome. In 6 months, someone was able to make 287 grand.
Yeah, I mean, is this going to be most people's first ever property development type deal? No, it isn't. And this particular member had done a few deals before, but this is the sort of thing you build up to, and it doesn't take years and years and years and years to build up to be able to do this sort of deal. What it takes is understanding how to read that market, how to understand the end values, working backwards from what people are actually buying, and figuring out, what do I buy the site for? Being able to
I'm just saying, so the property with as a 680 odd square meter block with the house on it, that was bought for what, 580, and then there's a 200 square meter block of lands that were selling for 365. What happened there? How did that did they just buy at a ridiculous price, or like who was?
Well, they understood how to spot value, and they understood how to put the deal and the numbers together in a deal in a way that would actually make sense. So would it have made sense in this instance for this developer to actually have built the houses? Would they have made this sort of money? Actually, they probably wouldn't have. So they looked at the different scenarios. What if I build it? What if I just sell the blocks of land? What if I do them as a house and land package? Where can I get the optimal profitability? And this was the ideal scenario.